So financial statements tell the story of a business. It's a way an entity can communicate financial information to the users of financial reports in the most straightforward way possible. So the entity prepares 4 basic financial statements. Firstly, we've got the income statement, which shows how much money a business earned and spent over a 12-month period. Secondly, we've got the balance sheet, which shows us what a company owns and what it owes at a particular point in time. It gives a snapshot summary of the assets, liabilities, and equity of a company at a particular point in time. Thirdly, we've got the statement of cash flow, which shows the movements of cash inflows and outflows in a business over a 12-month period. Finally, we've got the statement of changes in equity, which shows the changes of shareholders' interest over a period of time. These 4 financial statements show the financial information of a business in a number of different ways. So for example, looking at the cash flow shows us exactly how much cash a business has at a particular point in time, whereas the income statement shows us how much profit the entity made over a 12-month period. In addition to these 4 statements, there will be a number of notes which will go into further detail about the company's operations and also provide detail about the company's accounting policies that they've adopted. So financial ratios can be used to perform a health check and assess the performance of a business. These calculations use the information included in the 4 financial statements. For example, to assess the profitability of a business, we can calculate the net profit ratio. This shows us how much money is left after we deduct direct and overhead expenses from gross profits. To assess the liquidity of a company, we could calculate the current ratio, and this will show us the company's ability to meet its debts as they fall due. Shareholders and potential investors assess financial statements so that they can make economic decisions. For example, if they want to buy or sell shares or if they want to lend money to the entity. Similarly, banks and financial institutes would use the financial statements to decide whether they want to lend money to an entity or not.